I'd say I study the downside of every asset probably twice as much as I study the upside. You don't need to put a lot of effort into figuring out what the upside is. You just need to stay in it long enough. The upsides, I mean, name an asset class that's ever gone down. None
Right.
of them go down. Upside is a function of time.
Mm-hmm.
Downside is a function of timing.
Mm-hmm.
And so I'm interested in like what I've got here, price to value. Is it a good time to buy Bitcoin? The first thing I look at is where's the downside? And if you're at or below this red line, then the downside's not very big. The downside's manageable. What would cause the downside? Well, certainly an interest rate hike.
The opinions expressed in this podcast do not necessarily reflect the opinion of Arcos Global Advisors or its advisors. The mention of different asset types or securities do not constitute a recommendation for our clients. If you have any questions about the content of this podcast, please contact your advisor. Welcome to Navigating Bitcoin's Noise, the podcast where we cut through the clutter and bring you the most insightful perspectives in the world of Bitcoin. I'm your host, Kane McGukin, and today we have a fascinating conversation with Timothy Peterson, founder of Kane Island Digital Research. In our conversation, we dissect the upside and downside of Bitcoin. We explore the Kelly criteria and the secrets behind real wealth. Additionally, we delve into the application of MetCalfe's law as a Bitcoin valuation tool, and we discuss the influential power of large networks. If you're looking to gain a better understanding of Bitcoin's past and its future potential as an economic network, then this is the episode for you. Thanks everybody for joining today. I have with me Timothy Peterson. Always enjoy these conversations with Tim. He's come on a couple of times. He does great work at Kane Island Research on a couple of Bitcoin models, Metcalfe's law. He's got a new model, macroeconomic model that kind of mixes rates and Bitcoin, and we'll talk about that. But really, I think the key thing today is just starting to think about how to value Bitcoin. What's a proper valuation tool to help people that are in these markets better understand, not allocation from a standpoint of I'm going to buy or sell, but just better understand when Bitcoin kind of gets ahead of its skis and when maybe it is kind of in its depth and you would expect higher prices in the future. So, Tim, thanks for coming on again, and look forward to this conversation.
Thanks for having me, and Happy New Year.
Yeah, Happy New Year to you. Hope holidays went well.
Wonderful.
So I'll just kind of let you roll a little bit here, but really kind of looking at, you got on screen this Bitcoin lowest price forward model, and you got the traditional kind of logarithmic arc price of Bitcoin over the history up. Maybe you can tell us a little bit about this model and sort of the why behind what you're building it and how you kind of use it to just better understand this overall market.
Yeah, it's the interesting thing is it's not a model. It's not a model at all, and everybody calls it a model. And it turns out it's my most popular metric, but it's actually the worst metric I've ever invented out of all the ones. It's just the price trend. All you do is you take the lowest price that goes from a current period forward, and you look and see, did it ever get lower than that? And if the answer is no, then that's the price that gets recorded. So it's an observation. It's literally the historical price trend. It's the lows. It's the daily lows that you track, and what pattern do they make? And it turns out they actually make a pattern that's found in science. It's based on Metcalfe's law, and it is based on viral spread. But it's just an approximation. It has lots of assumptions in it. So for one, it assumes that price equals value in the long term. All right. If that assumption's wrong, then this metric is wrong. I think that value is right. We base all of our financial decisions on the assumption that price and value eventually converge if you're even remotely a fundamentalist investor.
So that's the key thing. And you heard that from Mark Yusko, you hear from Kathy Wood, and these are kind of like high growth people, or on the outside look like high growth people, but they're saying the exact same thing that you just said. it's a fundamental kind of deep value oriented way to look at this market, which is a kind of hyper growth, Metcalfe's law kind of carrying the exponential growth over time. Um, so it sounds like there one point was it really is just sort of a trend follower over time. This is the low. Next day, is there a lower low? Yes or no? And it just kind of keeps going until it sort of signals, hey, we haven't seen a low in a while. And
Ever.
so,
Yeah,
yeah.
it looks back the entire history. So it's the point at which it always went higher. And it is a trend, but uh, like I said, it does have basis in that S curve of adoption. Okay, and
Mm-hmm.
if you look at things, there's some math to it. It's got square roots and logs in there, but that's to adjust for Metcalfe's law in compound growth and S curve compound growth. If you don't know what an S curve is, it's just the adoption over time. And if you think about, initially a new technology comes out, it starts off very small and then it grows and it accelerates very quickly until eventually most people have it, and that the latecomers are always even later to get in. This math is just that S curve math. That's all it is. But it doesn't look at anything other than price. So it says, what if this price represented the S curve of adoption for Bitcoin? What would that look like if it were smooth? And that's what this does. And the fact that it's low is just to play. It's just to say, well, let's take the low end of that range, because price moves around the true value, it goes up and down. And I just decided, well, I don't like losing money. So let's move this line and shift it down. But all of the rainbow charts and the log scale charts that you see out there, they're all based on this concept. It's all the exponential growth combined with Metcalfe's law to produce a straight line. And that straight line is how I've developed what, when you get rid of the squared aspect of it, it turns into this curved line, this football shape. But it's still the same. And I use it for downside risk. I don't think it's very good at projecting anything at all. Like, I would not use this and say, well, it's been going this way, therefore it's going to go this way. Okay, if you do that, you get into trouble, because if you looked at what happened in January of 22 and January of 2020, that those lines were much higher. That trend was much higher, and then we had the first ever major interest rate hike that affected Bitcoin. In fact, it was so major, it was the worst one in bonds ever. This is the hardest rate
Mm-hmm.
hike we've had in 150 years.
Yep.
And that shifts that trend down substantially, because everything is affected by interest rates. So even as a predictor of downside risk, it's got some limitations, because we haven't had an opportunity until recently to calibrate the observation to different economic circumstances. Now that we've got that, the model's a little bit more robust.
And I think an important point there is it does, just like, I mean, I just use a simple one, more recent one is kind of how REITs and real estate got baked into the modern portfolio. Well, to that point where you're seeing, and we'll talk about that in a second, Bitcoin's reaction to interest rates kind of makes for the narrative that, hey, this is a new asset class being baked into the modern portfolio. It's where it's a digital asset being added, just like REITs were, a hard land asset, and you had timber and all these other things that kind of get put into that. So to me, it just adds a fifth asset class that investors could choose from, and it looks like, in my opinion, that digital assets, when we use Bitcoin as the proxy, are that thing that people can decide, hey, now's a good time to add some of that, or it's not. So on that front, the one thing that we had talked about offline was, and I saw a couple of your tweets, was how you've noticed that Bitcoin has began to react to rates. How has that changed your math and modeling, or what do you think about is important about that aspect?
Well, one of the things I looked at was, I don't like the price aspect of any type of model or observation, because I don't think it really tells you much of the story. So,
Mm-hmm.
I got rid of the price assumption, and I actually went out to the blockchain and I put real data in there. And you can look at this adoption curve, and then there's another one I have that's the full Metcalfe value. And you can see this Metcalf value. Well, it goes up and down quite a bit, but it does drop when we have interest rate increases, which we had in 2018 at the end. There were some in 2014 or 13, and there's the ones in the 2020s. That really does affect adoption, and the reason is because Bitcoin, if you I think of the Maslow's hierarchy of needs. Okay, I've got to pay for rent and food and clothing and shelter and healthcare first. Then after that's paid for, what can I do? I need transportation, education, and maybe some entertainment, and whatever's left over, I can invest and save. And some of that will go into Bitcoin. For the average person, none of it is going into Bitcoin. But if the cost of eggs and gasoline and clothes go up, that comes out of my Bitcoin budget first, because that's the top of the pyramid where I'm going to make the most cuts, because it's the least understood. It's the riskiest gamble for the average person. And that cuts into adoption significantly. And when you're talking about exponents, small changes in an exponential value relate to huge changes in linear terms, in dollar terms. So the example I heard was, if you take 20 steps across a room, you've walked 60 feet or 40 feet. If you take 20 exponential steps, you've walked around the world 3 times. Now, if you just take 2 less steps, you've almost cut off an entire trip around the world. So small changes in growth rates that are compound growth or exponential growth translate into huge differences, which is why forecasting Bitcoin is very difficult, because it's a very exponential growth asset, exceptionally so.
You ever heard if I gave you a lump sum $1 million, or gave you a penny that doubles every day for 30 days? So,
The doubling penny, right?
Yeah. So the 20 steps, and you said if you take 2 less steps, you basically almost don't go around the world, or it drastically changes, right? Because of the exponential nature of it. So within that assessment, so you take the $1 million, and everybody's like, oh, $1 million, I'll take it. But the penny that doubles every day, at the end of 30 days, it's just north of $5 million. But what's interesting, if you kind of put it in a spreadsheet, on day 27, it's only like 600,000.
Right.
So the last 3 days, just like your kind of 20-step analogy, is really where, quote unquote, all the money is made, because that exponential factoring just like really kicks in. So that is interesting. And I think that is, to your point, at least I think that was your point, where Bitcoin is truly different. And we still, other than kind of your work, and that's why I enjoy these conversations, haven't figured out an appropriate valuation metric. So, in these pumps, you just get narratives that are all noise, and people jump on them, and just, in 2016, 17, 15, it was, if you said anything about Bitcoin, positive or negative, the response was, it's decentralized. And you're like, well, that doesn't mean anything. Now it has a meaning, but from a valuation metric, doesn't have any meaning. And, then you come into the 2020, 19, 21 is like, it's an inflation hedge. Well, when inflation ripped, it died just like gold, right? Because it was more of a signal of inflation. And that's just a couple that come to mind. So the reason why I bring that up is, to me, these valuation metrics are important, because it can, narratives are still going to be drivers, but they allow us to truly see where the opportunity or better times to be allocated to different assets are.
Yeah, I've looked at this quite a bit, extensively over the past 8 years, and the value of a network is based on the size of the network. It makes up 80% of the value of a network, and that's true. Mm-hmm. I've looked at dozens of networks, not just Bitcoin and cryptocurrency. I've looked at things like Tesla, Microsoft, Adobe. The theme is pretty clear. Metcalfe's law is what drives the value. The problem is that price is noisy, and so when you try to compare it to price, you have to account for these anomalies. Things like hype, things like the extreme price inelasticity in Bitcoin, things like interest rate changes. And so a lot of my work the past couple of years has been on working on, for example, how does limited supply affect Bitcoin's price behavior, and how do interest rates affect Bitcoin's price behavior? And so I've come up with some additional work that fills that out. One of these days, I will get all of this information out of my head and into a book. I've got actually two books in my head. They're fully written. It's sort of the way I operate, and it's just a matter of time to get them on paper.
Yeah.
But yeah, there's a lot to be said about fundamental value, and I haven't found anything else that comes close. If I had, I'd be using it, but
Right.
I just can't find anything other than adoption network size equals value, and price moves around that value based on circumstances.
So two questions. We'll get back to the interest rates in a second. But when you look at this chart, so you got the Metcalf value and the Bitcoin price. Is it like traditional markets where you got a pair and arbitrage? One does not go to the other. They both kind of converge to a point, meet, and then there's a time where they set and settle. Or is it, say, Metcalf's value drives and Bitcoin price works towards that, or the other way around?
What I've seen, because I've looked at this, does the model signal anything in advance? And if you sort of zoom in on some of these, it looks like it sometimes price leads and sometimes it doesn't. What I've found is in the very short term, in some cases, the the network will take an advance and go up, and then price will follow. This is a good example. This is recently in 2023. The value started going up after this bottom. Okay, so this was the bottom. We have FTX price crashes down to 15,000 plus. Value didn't budge.
Mm-hmm.
The size of the network and the activity on the network still supported value that was in the 20s, and it's been growing, and it's been growing at a rate of about 20 or 30% per year. That's the number of users. Okay, so when you
Mm-hmm.
have a 20% growth rate, the rule of thumb for Metcalfe's law is double it. You get the price growth rate. So a 20% growth in users makes a 40% growth in price. We've had a little bit more than that. We've had about 60% this year because it dumped down to well below value. But other than that, the Metcalfe's value has been leading all of 2023, and I think it will probably lead a little bit more. But it's a very short term. I think for the most part, price corrects to value. We saw this when I'm going to go back here to 2020. Okay, this big dip that happened in May of 2021. There's a huge drop in Metcalf value in users.
Mm-hmm.
You can pinpoint that date to the date that Elon Musk tweeted that
Right.
Tesla was no longer going to accept Bitcoin for payment for Teslas. Okay, that caused that drop, and the market was slow to react, but it eventually does react. Okay,
Yeah.
we went down from there, and of course we had the interest rate environment come in as well in 2022, which sort of sealed the deal. But the value had always been much lower, and price was overrated more or less. And so my sense is that value hits first, but it's not always observable. I mean, we don't really know what the value of Bitcoin is. This is an estimate of value, and who knows if it's right to the penny. But I think it's right to within a few $1,000 most of the time.
A lot of that in terms of the network value being higher than price or lower than price or changing when someone like Elon tweets that, hey, our business is, moving away from Bitcoin, where 3 days before he said we're going all in on Bitcoin. I know it was not 3 days, but just kind of being a little funny about how Elon changes his mind from Monday to Friday. Um, the value of the network, it kind of proves out the whole, brand thesis, right? Uh, Big brands, they tend to grow big values. Word of mouth spreads and feeds that brand and continues to feed that brand, and then they become the de facto brand, just like Facebook or Netflix or Instagram or any of these different platforms, if you will. And Bitcoin, some of the early days or over the last couple of years, you've seen the kind of discussion of one of the most positive characteristics of Bitcoin is it's built that brand as kind of the leading protocol. Is that fair to say, or
That's exactly right. And networks in particular have what's called a feedback loop. Okay.
mhm.
The biggest network gets bigger because it offers the most connections, which means it offers the most information, the most opportunity. If you're a producer, it's got the most reach. So YouTube is the leader, and in fact, it's always going to be the leader. Bitcoin is the leader, and it's always going to be the leader. It will only get bigger maybe at the expense of others, but maybe not. Um, Microsoft, which is a network, okay,
Yep.
Adobe. And
Hmm.
it's typically the case not only do the big ones get bigger because large networks attract users because they want to network, right, just like
Hmm.
Facebook, but usually the first one wins.
Right.
So Bitcoin was first, and it gets the most users from the get go, and it forever has an advantage over everybody else. All this other stuff that comes in later, these copycats, there's room for one or two Me Too's in there, but typically, if you're the first mover, you're the final winner, and you will not be surpassed. Tesla is an energy network. If you look at what Tesla's done, I don't care if Tesla sells zero cars. They've built the energy network that is going to power every electric vehicle in this country and through most of the world. And if you look at what's happening with Tesla, other manufacturers are saying, well, we're just going to use Tesla's charging standard. We're going to
Hmm.
have our cars hook up to Tesla chargers. This is like being Con Edison in the 20s. Okay.
Right.
You're the first there. You've got the electricity. Everyone else is going to adopt your standard. So Tesla's going to get huge, not because of their automobiles. Their automobiles are nothing. It's like saying Amazon is a bookseller.
Right.
Tesla's an energy distribution network, and that's incredibly valuable. And they're only going to get bigger because it's just going to be more convenient to hook up to the Schelling point of Tesla's chargers than to reinvent your own. And all that value accrues to the Tesla network, and that's where the value of Tesla is. Bitcoin's the same way. Why do I want to go invent my own, faux Bitcoin and try to convince people to use it when I can just go out there and buy Bitcoin
Right.
or mine Bitcoin? It's so much simpler because now I have an instant revenue base.
And Amazon's a good example, right? They built this, tiered platform of selling goods and services. They started with books, but it changed the way that people sold online or brought their products to online. And a lot of people just said, why would we try to build the network when we just, give Amazon part of the fee and put our product there and they'll kind of help us get into that, Amazon brand, if you will. And you mentioned Tesla and, banks are the same way. We've got really maybe 10 banks around the world. Well, they spent 100 years building that network, and the dollar network is that dominant network that why are you going to deal in one of the other 180 currencies when you can make it simple, get some dollars and kind of purchase anywhere. So that all is very interesting. On the rates front, switch gears here. What is it about rates, I guess, that you've discovered, found, or added to your work that's kind of a change from or an addition to, the Metcalfe's law models that you've been working on?
I wrote Metcalfe's Law back in 2017, which was the first peer-reviewed published Bitcoin valuation model. This year, I wrote a research note, which is probably the most important research note I've written since then. And you have to go back a little bit. All these bumps in Bitcoin's price. Okay, 2013, 2008, 17, 2021. The predominant theory is that it's halving. I know for a fact that yes, the halving has an impact, but it does not have that much impact. And we can look at the network activity and we can look at how many people are joining and things like that and say halving does not account for the increase in Bitcoin's price. Okay, there's
Mm-hmm.
math and economic models behind it, but it's just not. I had done some research, which I got published a few years ago. It's in the Journal of Forensic Accounting about price manipulation because a guy in Oklahoma at the University of Tulsa and several of his colleagues wrote a paper about the Mt. Gox collapse and how there were bots running on Mt. Gox,
Right.
pumping up the price. And you can actually see it in the price. It's early 2013 and late 2013. Those were the Willie and Marcus bots. And they're out there. There's lots of research about Willie and Marcus. And it's not speculation. Matt Carpole, who ran Mt. Gox, admitted in court, yeah, I was doing it. Okay, so
Right.
there is real manipulation in 2013. 2017, there's a theory about Bitfinex and Tether and some finagling of stuff behind the scenes. And researchers from the University of Texas attempted to prove that was what was going on. I do think that was what was going on, but that was just one thing that was going on. So I had attributed these bumps. Yes, it was having in some height, but there was lots of price manipulation going on as well.
And you could argue even this big run up to 69,000, there was manipulation there. It was FTX. And
here's what I've learned.
A lot of other things.
Kane, I've learned that I think I was wrong about the manipulation. I went out and got some interest rate data and some US dollar data, and I plugged that in on top of MetCalfe's value. Okay, so I said, well, what happened to interest rates during these times when the price was deviating so substantially from the MetCalfe value? And what I found was rates were declining quite a bit. And then when rates went up, that bubble popped. And the same thing was happening with the dollar. And so my predominant thesis right now is that, yes, there was manipulation going on, but the overriding factor was macroeconomic. Interest rates drove these cycles far more than the halving and far more than manipulation. And you can see it in the data. And in the research paper I wrote, I actually apply out the high yield rates and the dollar rates, and they just overlap almost perfectly with Bitcoin, almost perfectly. And so what happened in 2021 is we had the COVID rate cuts, and we had extensive leverage. Now, I don't account for leverage in any of my models because the exchanges don't say how much is leveraged.
Right.
It's a dark pool, those exchanges. But we do know what was happening with the available money supply. It was soaring. The dollar was extremely strong. And all of that influenced the price of not just Bitcoin, but every asset. So in 2021 and 2022 that you had an everything bubble, the difference between a Bitcoin bubble and, say, a Tesla bubble or an AMC bubble is nobody's out there issuing more shares of Bitcoin trying to take advantage of it. Okay, that fixed supply really does matter, and that's where you get these 10x's. A small amount of influx of capital into that ecosystem can create huge price spirals upward because the only Bitcoin available is what's out there. And they're only making 6 more Bitcoin every 10 minutes. And even that gets eaten up through lost Bitcoin. I think that the supply right now, I think since about 2020 or 2021, the available supply, when you subtract out forever lost coins, it's been shrinking.
Right.
It's been at 13.5 million and going down because people send it to the wrong place or they lose their keys or whatever it is.
I think that's an important point too. If you study monetary networks, monetary history, that really it's liquidity, right? And there's base money, which is money that can't be loaned against or isn't encumbered by loans, I think is as Mark Yusko says, and everything else is currency. And and Bitcoin sort of has both of those features. It doesn't really have the currency piece that well, but as you pointed out, when the networks that are currencies print additional money, a liquidity, it has to go somewhere. And once, the traditional, and I think that's how, in my opinion, Bitcoin is and will continue to be embedded into modern portfolios is because we're in a cycle of continuous liquidity. There may be periods where they turn it off, but then they turn it back on because they don't know another way or aren't willing to make the hard decisions to do things a different way.
Well, there are no good decisions.
Right.
In part because demographically we're not growing at the rate we were after World War II. So we have basically a shrinking supply of labor and decreasing productivity. And with in that environment, prices will eventually go down. Now,
Mm-hmm.
no politician or banker ever wants to see prices perpetually go down. So the only thing you can do is pump money into the economy to keep it up. And so that's what we're going to do. I mean, there's no question about it. It's just a question of what's the degree. So that money's still going to be out there and still flowing.
Right.
It's just sometimes it'll flow more and sometimes it'll flow less. But the more you pump out there, the less it's worth. And I just found out yesterday. I looked at the M2 money supply. The rate that we produce money is realistically the M2 money supplies. It's set to double in 15 months. In
Yeah.
50, we're going to go from 22 billion M2 to 44 billion M2 within 2 years. Now,
Yep.
maybe it takes 3 years. Well, who cares? 3, 4? That's an incredible amount of money coming into the economy just to keep it afloat, to keep this price decline from taking hold. And that's not going to change. It absolutely cannot change. So
Right.
some more of this is going to flow into Bitcoin, and the ETF, I think, is an underrated uh, creation.
Well,
And
that's the point of liquidity that comes into a market, and the world and all markets will always be based on some liquidity. It has to go somewhere. And if these other asset classes are full, or in an investor's mindset, I have enough allocation to this thing, well, they're not going to just go buy more bread because they have more money unless there's a need. As you mentioned early on, we buy the things we need first. But once there's excess, if my portfolio is full, if my pantry is full, if my physical assets, real estate, gold, whatever else is full, if I've got enough tools and I still have dollars left, I can't put it in my checking account. So it has to go somewhere.
I think one of the most important things the ETF does, and the thing that Fidelity did recently in putting it as an allocation option in their 401k program, is that it normalizes the asset.
Right.
That is the hardest thing to do. And I'll tell you, the equivalent story is the story of mortgage-backed securities in the 80s.
Mm-hmm.
These were, if you ever seen the movie Big Short, that was a story of mortgage-backed and collateralized mortgage obligations. So basically, you take a bunch of people's home loans, and you package them into a single bucket that then pays out interest, and somebody can buy that bucket and they'll get an interest payment. The problem is if home prices change or if the economy turns sour, then the size of that bucket shrinks and your interest payments go away.
Mm-hmm.
That happened in the 80s to an entity called Orange County, and it was a big deal. And there was this huge backlash against mortgage-backed securities and these what they called risky derivatives, and the insurance companies were all over it, and the regulators were all over it, and they were getting lambasted for the big firms like Morgan Stanley and Goldman for producing these ridiculous assets that only hurt people. And you know what? I would say mortgage-backed securities today make up the lion's share of every financial institution portfolio in America, at least certainly the insurance companies and pension funds. They
Yeah.
all have a huge allocation to mortgage-backed securities because it wasn't that the instrument was bad, it was that people didn't understand it and they didn't understand the behavior. Once they understood how the price behavior worked, then they could manage that risk. The same thing is going to happen with Bitcoin. Once people learn that it's not just speculation, that it's not stock to flow, that it's not based on nothing, that it's not money out of thin air, once they realize what network effects are, then they can start to metric those risk measures and manage that in a portfolio with other assets. And it's huge. And Bitcoin, I think, can be a huge allocation to
Mm-hmm.
a typical portfolio. I think most institutions and most financial advisors right now don't even know what they don't know.
Correct.
They just don't know what they don't know, and then that learning curve is going to be long. However, younger generations are going to come along and they're going to read more and more about it, and the more people that are out there that say, "Well, this is what we do," and it's network economics, then it's going to be much larger allocation than the 2 and 5% that are envisioned by some people today.
And to step back, I think all those are very important points. And the latter part I do think of is important, and it fits into that. More liquidity has to go somewhere. New asset class gets into portfolios one way or another. So I think all those things are good. I think it's positive for the future of finance and finance. The technology around money, currency, investing changes, and we're just in a drastic change, like a industrial revolution. It's a digital revolution. Data drives everything, and now we're getting connected money. But to your MBS point, to support that, and I didn't do a deep dive by any means, but it's clear. If you look at the headlines, the Fed now allows, because they can't, there's not enough treasuries out there, they allow riskier and riskier assets, MBS, CLOs, CMOs, all those things, the CDOs, all that stuff. They're taking that on their balance sheet, one, to help the liquidity issues, but two, to your point, they better understand the risk around it, whereas there's still a lot of risk in it, but the modeling, the comfort, the better understanding of default rates and how that filters through the system is better, because otherwise central banks, other than they kind of have to in this environment, they wouldn't take on that stuff, right? Anybody that does the deep fundamental value or fundamental understanding of what's inside those esoteric securities, they wouldn't take them on. I mean, you'll take some risk, but not in huge volume.
Right, and I think the difference between a the professional investor and amateur investors is they do that risk management. I'd say I study the downside of every asset probably twice as much as I study the upside. You don't need to put a lot of effort into figuring out what the upside is. You just need to stay in it long enough. The
Mm-hmm.
upsides, yeah, I mean, name an asset class that's ever gone down. None of
Right.
them go down. Upside is a function of time.
Mm-hmm.
Downside is a function of timing.
Mm-hmm.
And so I'm interested in like what I've got here, price to value. Is it a good time to buy Bitcoin? The first thing I look at is where's the downside? And if you're at or below this red line, then the downside's not very big. The downside's manageable. What would cause the downside? Well, certainly an interest rate hike. That doesn't seem to be on the horizon. There could be some geopolitical thing like an attack. That probably is on the horizon. And then there's a few other things like some technology problem like an EMP, like, some sort of freak event or something like that that could cause a lack of faith in the technology or its resilience.
Mm-hmm.
And you know those last two are kind of rare. I don't know that they're even so common that they couldn't be overcome with just waiting. So when I look at price to value, whether it's lowest price forward or a Metcalf value, I'm looking to see where that value is and what's my downside and how long do I have to hold it for. Right now, if you're gonna buy Bitcoin, I'd say that the business cycle runs 3 to 5 years, and if you're at fair value, you can probably make money in a 3 to 5 year time period, almost certainly. If the price is above that value, then you will probably lose money in the 3 to 5 year time frame. And if you're below that value, you'll probably make money well in advance of that 3 to 5 year time period. And that's how I look at it.
I absolutely agree. I look at some of that stuff myself, and one comment you made about really focusing on the down, like what's your downside exposure. Greg Foss is really big on that. He's been on a couple of times. Great guy. Basically, he says that's, you think like a bond trader. The first question you ask is, "What's my risk?" Meaning, what's my downside? What's my potential for loss? But the typical investor says, "How much am I going to make?" That's an equity mindset where you're just like, "I'm throwing money at this thing because all I see is 50, 100, 300% upside," and they disregard the downside. And that's where they get caught off guard. And that fits back to that theme early on. I said, you have done the math, done the work, proof of work, kind of looking at the market same way Mark Yusko does, same way Kathy Wood does, same way Greg Foss does, in terms of what's the fundamental value. Because if I'm making a purchase or getting in a market, doesn't matter what it is, when the value is too high, my chance of loss is pretty, not guaranteed, but it's pretty high. And my chance of gain, the positive rosy outcome, is very low. So it's not favorable. But if I'm getting in a market, in an asset, in whatever, when the probability of winning is much higher, meaning the value is much lower, that's just optimal. And then, like you said, it's time, it's time in the market versus timing the market.
Right. You mentioned some things about the prospects of up and down gains and losses, and I too late in life, I think, came across a formula called oh gosh, what's it called? The Kelly criterion. And first of all, there's lots of bad Kelly criterion formulas out on the internet, so I really had to find a web page that had the correct ones and explain why. But one of the most important books I ever read wasn't out of my schooling or CFA or Warren Buffett. It was a book called Fortune's Formula that explained the analysis of upside and downside and probabilities. And it's a really simple formula. I mean, it has 3 variables. And it was way more easy to use that than it is if you've got a finance background in portfolio management. You know what the Markowitz formula is, which I had to memorize for my CFA exam for the 2 asset portfolio. It's all these Greek letters and squared and square root. And it's got like 10 pieces to it. And even Markowitz said he never used it. He said, I just put my portfolio 50-50 because the formula was too hard to do in your head.
When you have to like recalculate it so much.
Yeah. And he was from a time when computers were just getting started too. So in fairness to him, he didn't have Excel. But even with that, I can scribble out on a piece of paper, win divided by loss minus probability of loss divided by gain. And that's the formula. And then you cut it in 2 for a margin of safety. And the numbers I get for Bitcoin are in the 60s, 70s, and 80%. And that's the half allocation, right? The full allocation says go leveraged all in. Well, I'm not going to do that for reasons.
You got to survive to fight another day.
There are other considerations than just living in the moment. There's time horizon. There's liquidity constraints. There's other things. But the interesting thing was I had been running this Kelly criterion allocation, which I keep secret. I don't want to influence people's allocation. But I had been running it for several years on the same spreadsheets I've been doing the other ones. And, they would consistently say about 80%. And then BlackRock came out, I think it was this year or last year, and said, well, the optimal allocation is 80%. And I said, well, I know it is. The math is not a secret. Anyone can go out there and get it. It's just a matter of doing the work and finding it out.
Yeah. And I think to piggyback on that, I spent a lot of time reading trading books, options, probabilities, all that kind of stuff, or not early on in my career, but like mid and early, and not coming across the Kelly criteria and that formula, but absolutely coming in or coming at it and learning like how big probabilities are in your outcomes. It's not about being right or wrong. It's about the probability of and playing when the probabilities of you being right are better than when the probabilities are of you being wrong. And I think Van Tharp had some day trading books that basically had formulas very similar to the Kelly criteria. It may have been the same ones, but where you just, hey, what's my odds of winning? But that's also what sports teaches us, right? We're going to call this play or do this thing because the probability of success are higher than if we make a different choice.
Right. You don't want to be the underdog, right? If you're an investor, you want to be the casino.
Right.
You don't want to be the guy on the other side who's counting cards. Okay. Yeah. And counting cards works, but you've got to be perfect with it.
It's a low probability.
There are people out there that can do it, and they can do it in the stock market. Okay. They can look, and they've got the skill, but it's incredibly difficult. It's much easier to just be the casino, and bet on the thing that's going to win 60% of the time. When you win 60%, actually, the stock market only goes up about 55% of the time. Mm-hmm. If you're going up 60% of the time, you're consistently beating the market. And I talked to some people at Bridgewater
Hmm.
I was on the phone with them, and I said, I think the best I can do, and I think the best an asset manager can do is probably be right about 60% of the time. And they said,
Yeah.
well, that was our assessment. I was like, well, that makes me feel good that Bridgewater
That was my
says,
assessment. I mean, it
yeah,
was somewhere between 50 and 60. If you consistently hit that, you win over the long term.
you're the casino. You're just raking it in over time, and you will just get bigger and bigger and bigger at the and beat everybody else in the
Right.
process. You'll
You're
beat the
you're
average.
the probability of you hitting a home run and somebody writing an article about this phenomenal call at the bottom or at the top that you made is low. But does that really matter if you're using your money and your currency to kind of fulfill the lifestyle and the needs that you want and you have by just kind of like slow plodding? I think we all get impatient. Uh, I think the easy button was the worst marketing ploy ever because now everybody just thinks it's easy. And when you look at any successful business owner, investor, whatever, somebody that's created, real wealth, it's like a 10 or 20-year process, right? Because they're every day playing positive probabilities, not kind of the easy, quick wins that are really low probability outcomes.
Right. You can do that with venture capital, but
Yeah.
it does take a certain skill. It really does.
Hey,
And, the truth is, I don't have it, and
yeah,
most people don't have it. So
right.
do what you
It's
can
like
do
card
and do it
counter. Like
well.
how many people can go to Vegas and count cards?
Yeah, I tried it once. I actually went to Vegas and tried to do it. I'm like, oh my God, this is so impossible. You've got to practice for a
Right.
long time to
Yeah.
try to do it properly. Because if you make a mistake, the whole thing goes away.
Well, and that's to the point, right? So if you spend 3, 4, 5 years, 2 years, whatever, to go play one night or two nights, that the time and effort that you put in much, much longer, much, much more difficult, much more grueling than the 24 hours of winning you got to experience.
Yeah, the interesting since we're talking about this, and we mentioned the Kelly criterion. Kelly and his pals actually got started trying to figure out how to win at gambling. They started with roulette, but roulette required machinery, the ball and the spinning thing,
Yeah.
and then they went to blackjack, and they were the ones that invented card counting. So the formula I'm using technically is a card counting formula, but it doesn't rely on wins and losses historical the way card counting does. But they took the card counting technique and they went to Vegas, and by the end of their first day, or maybe it was the end of their second day, their pictures were up at every casino because they were raking it in. They were just emptying these casinos out of the money, and no one could figure out what they were doing, but they knew who they were, and so the other casinos communicated with each other, and they sent their pictures out to everybody else and said, if these guys come in your place, you kick them out. And so by the end of the day, they got kicked out of Vegas. That's how good they were. That's how good. And then they took this formula, this original card counting formula, and they changed it a little bit to be a generic gambling formula, which then morphed into the Kelly criterion, which you can use for portfolio management.
Is that
But
the movie something 21?
there is a couple of movies about it. It is in The Big Short. They allude to it a little bit, but there is another movie with Kevin Spacey where they actually go do
Yes.
card counting.
Ashton,
But the
Aston.
but the origin of that was from guys at Bell Labs, these scientists who really knew the math. And Ed Thorpe later then went into investment management. So that's the biggest casino is the markets. So if you want to know what works, go with the math because that's what gets you kicked out of the casino if they figure out what's going on. Now the Kelly criterion is not illegal by any means. It's just a way of saying bet on what's going to win, and you can figure out the odds using historical data. It's pretty simple.
Yeah, when you're playing and the house doesn't win, you're on to something because all these, for lack of a better term, casinos are built for the house to win. Um, Looking at this price to macro value chart here, the one thing that stands out to me, and I've got some other things that I look at that basically show very similar, is how similar this sell off from the top into this bottom, and we kind of had this bounce here, and it looks like we're working out a bottom and all that stuff. how similar that looks to that 2015 to 2017 time period.
I've seen the same thing, and not just in this chart, but in many other charts. This really does feel like 2015.
Mm-hmm.
I think 2016 is was an okay year, and so I think 2024 will be an okay year, and then we'll see what happens. Are we going to have another rate cut? I think it's if you think you've got it figured out. My experience is that you haven't got it figured out.
Right.
Something else is going to happen. So I don't think we have one of these big bumps. I'm going to go on a limb here and say I don't think we have one of these big run-ups like we've had in the past. I think the Fed's going to cut rates slowly. I
Mm-hmm.
think this run-up will take place over 2 or 3 years. It will get there, but
Mm-hmm.
we'll correct. Realistically, I'm seeing in some of my models that I do, if you work in the interest rate path, I'm seeing 100,000 in maybe the end of 1 year, but
Yep.
almost certainly at the end of 2 and 3, and then you get to 1 million. Best case scenario I have right now, I saw 1 million at 2028.
Yeah.
And that was in line with what my old forecasts had. They weren't really forecasts. It was just the old price trajectory was
Right.
2028. And then I revised that after this crash because the price is certainly sensitive, and it came out to be 2033. So, but somewhere in there between 2028, 2033, $1 million Bitcoin is on the table. And that's not a very long time horizon. Okay.
No, it's really not.
I don't know what your financial situation is, but you're not going to have many opportunities like this in your lifetime. You just aren't.
Well,
And so I'm incredibly optimistic right now. Even with as bad as the world is and as bad as the economy is, I think there is some real hope there in terms of wealth creation through Bitcoin and probably a few other networks as well.
a couple of things stick out to me there for all those comments. I agree. And, one, you do see just in these peaks and just in the markets, if you've been in this market for a long time, the exponential upside has declined over time. The price is going higher over time, but the multiple of which is shrinking. And I think probably, I'm not no expert, but probably just due to like adoption and the early guys win, and as time goes on, every new investor doesn't have the same high returns because the volatility compresses. But to your point about basically upside and when we might hit some higher number, if you just do the basic math on the blocks and you just look at average lengths of bull and bear markets and the cycle, I've done some just very basic work on that. Yeah, we still have time before we get that lift off, and then you have a year and a half run, and then you go into a bear market again. I mean, Bitcoin has historically over and over and over, and that's that 4-year halving cycle. I'm with you. I think the halving is much bigger narrative than it is. Yeah, it's true. There's less Bitcoin on the market and all that kind of stuff. And then when you factor in what's lost and, it's scarce, but people have many other needs before they get to Bitcoin. And they have many other things that they have to satisfy, that they have to purchase just to live before they get to Bitcoin. Now, where you choose to save is totally up to you. And I'm kind of the thought that Bitcoin is something you should consider saving. But to your other point, everybody's different. So you kind of got to figure that out. And, it is kind of up and to the right market because most markets are, but there are better and worse times to, start buying. And that's the probabilities. And these are the kinds of things I wish more people spent time on. They're not as fun, right? And we can't go spin up memes that just make us emotionally feel great about them. But I think they are more important aspects because, look, Bitcoin, and for as great as it is, it's still so early. There's nothing going on but trading. I mean, there are things going on, but we don't, I kind of equate it to social media. Big corporates laughed at it, made fun of it, thought it was a dumb waste of time. And then they started to realize after 5-10 years, I think you started seeing Twitter and Facebook images on billboards in kind of 2012, 2010. They're like, wait a second, there's a network that we can push products into. We've got to be on that. We've got to be using it. And that made them valuable. And I think Bitcoin in this cycle will probably figure out what things on top of the protocol layer can be used to create business opportunities and that, opportunistic outcome versus like the bear scenario of what's going on in the world, because price is telling you good things are happening. And I know you're not a price guy and that's totally fine, but the headlines are just telling you it's doomerville. And price
Here's the why.
generally leads
You're
headlines.
right. Yeah, and no, price does lead quite a bit. I mean, price leads. This isn't this is a true model, but it's not necessarily predictive in the short term.
Correct.
So one of the things that you look at, if I go back up here and it says, well, it looks like price goes up before. Well, this isn't meant to predict the price.
Right.
This is meant to tell you what the price should be on that day.
Mm-hmm.
But the looking at the chart, the visual is a little misleading. Excuse me. If you come down here and you look at the ratio, you do get the peaks when the price peaks were. Okay, so and this is really the story here. So this tells you
Exactly
whether it's away from the price, not whether it's leading or lagging, but is it above or below?
Yeah.
That's what tells you. You can forecast the price easily. You forecast address growth, which you get those numbers off the blockchain, and then you need to forecast interest rates, and that's a little bit harder to do, but you can do it. Okay, that's your Bitcoin price forecast. That's fairly simple. Now it's got a wide range, but that's there. To your point about what institutions and what traditional investment managers are coming in to do, would you rather buy Bitcoin and hold it, or would you rather just get 2% off of everybody else's Bitcoin?
You're right.
And if I'm an institution, I say, oh, I don't care what the price does. I don't even have to understand the asset. I'm just going to take 2% of everything you give me every year.
100%.
Regardless of whether you move it or no. And so I don't have to put up any capital, practically. To launch an ETF, you need $500,000 of working capital, and then you probably need a few seed investors, which is somebody else's money. So your money that you put into is minimal, and then you just sell it. Right? I've got the hot asset, and the more assets you get, your 2% piece is going to grow and grow and grow in terms of dollars. And that's what these guys are doing. I have never seen any frenzy like I'm seeing over the Bitcoin ETF in terms of
it's so crazy
to get in it. Look at how many gold ETFs there are. Gold's been around for 6,000 years. There's 3 or 4?
Yeah.
There's 3 or 4 gold ETFs. There's 1 or 2 silver ETFs. There are a handful of stock market ETFs that are core. And then there's all kinds of variations, right? Because what's the idea? The idea is not to give exposure to the people. The idea is to convince them that they need it, and so you have to differentiate. So they sell them all these different variations. I unfortunately I think that's going to happen with Bitcoin. We're starting to see it. That we're going to see all these different colors of Bitcoin ETF, all of which will be inferior. And I'm going to make this prediction right now. Anything that comes out that's a Bitcoin ETF that does tweaking to it is going to be worse than just the Bitcoin ETF. All right.
Absolutely.
So if you're an investor, and I want to give you some advice here, free advice, don't go for these crafted solutions that these large institutions put out for you. Whether they say, hey, it'll protect you from the downside and cap the upside, or we're going to guarantee you 7% plus a fraction of the Bitcoin. Don't ever do any of that stuff. I don't care how good it sounds. Buy the regular plain vanilla Bitcoin ETF and hold it until you the day you need it. All right, the day you retire. That's my advice.
Yeah, I mean, I couldn't agree more with all of that, and it's all very true. If you spend any time looking at it and thinking about it, you can't, if you want to own an asset, it doesn't matter if it's a hammer, a car, a house, or Bitcoin, whatever it is, own the asset. Don't own the wrapped asset, because the wrapped asset has embedded characteristics that will not respond to the actual underlying asset the way that the underlying asset responds. In addition, there are the fees. Now, I get it. 90% of the world does not want to do the not your keys, not your Bitcoin. They just don't. And we can't make them. We can't convince them. It's kind of a dead battle. So not 90%, but a lot of people will buy an ETF because they want the FDIC insurance. They want to remove the fear. And then what I mean by that is the fear of losing their Bitcoin and losing their money. All that's warranted, but like everybody, to your point, everybody has to make their own decision.
Right. Somebody said, people can't keep track of their car keys. How do you expect them to keep track of their cryptography keys
That's
for
what,
Bitcoin?
yeah.
And when it's gone, it's gone. So the guardrails around that are virtually non-existent currently. Sadly, I think there could have been an opportunity, but I think the entities to provide that service are in the banking industry. They're experts at custody. And they've really lapsed. They've always viewed it as a technology product, not a banking product. But in truth, password security and information security is something that banks should have been doing for the past 20 years, and they've completely dropped the ball on it. So here we are, where we've got a monetized password cryptography product, and they're unskilled and they don't understand it. But the Custodia Bank is trying to remedy that and they've done some really good work.
She's good.
Yeah. But it's a long haul because the education isn't there yet on the regulatory side and on the client side and on the banking side. So it's still ground zero in many respects for institutionalized Bitcoin, because the whole idea of custody, Bitcoin was designed to get rid of this concept of custody. However, we live in a world where everything is structured around custody. So it's way beyond square peg round hole. And it's going to be much easier to wrap my Bitcoin in a paper product. It doesn't make it paper Bitcoin, but it does improve accessibility. And it makes that somebody else's problem. So when I look at an ETF, all I do is I say, I am subcontracting out my custody solution to somebody else.
Yeah.
Right. That's all I'm doing. I still own the Bitcoin. I still own the asset. And even though there's a paper legal path that in theory constructs all that, if that breaks down, then a lot of other things have broken as well. And I can always protect by self-custodying some Bitcoin. But if a meteor hits, there's nothing that's going to protect me anyway. So I don't go based on what the worst case scenario. I go based on the likely scenario. The likely scenario is I'm going to lose my Bitcoin. When I'm 80, am I going to remember what all how to do it all and how to tell my heirs how to get to it? I don't know, but I certainly know that if I have an ETF and I sign the beneficiary form, everything's taken care of, and my money will transfer.
It transfers on a bad accident. Yeah. I mean, look, I'm torn, but I understand what the normal emotional response to fear is for the average person. And, it is what it is. Satoshi said in one of his posts, one of his posts, I think it was one of the later ones, something to the effect of, sorry, I don't have time to convince you. Right. And that's just kind of where we are. So, Timothy, I appreciate it today. A lot of great stuff as always. Is there anything else you kind of want to share or say? Great work on these models, and thank you for putting this stuff out. It is all phenomenal research.
I'm just going to plug my book shamelessly. The Debauchery of Currency is out on Amazon, Google, Apple. It's a bloody history of money, and it teaches you what money is, why money has value, how it's evolved over the years, and why Bitcoin has value, most importantly. And it gives a glimpse into the future. So it's out there, and I'd appreciate it if you go take a look at it.
Yeah, and I got a copy that I got from you. I appreciate that, and I can say all of Timothy's work is good. It's very well researched and put out. So I encourage any listeners to look, follow, listen, buy the book if you want. Go to the website and look at the charts if you have interest in that kind of stuff, because it is truly different. And it's well researched work. So nice job.
Well, thanks for having me.
Yeah, thanks for coming on.